I want to start off the show as usual with a summary of kind of what I saw happening with the markets. And really, Lisa and I will kind of have a discussion about it. We'll talk about, what we see happening as far as that goes. So here is the S&P 500 really since the beginning of last year, right? So that was the peak on the 4th of January. We hit the highest point of the S&P 500 ever. And of course, we've had this rolling downward market that you see there. At the lowest point on October 13th, we were down 28% on the S&P 500. And we basically at that point retraced half of the gain we made from the bottom of 2020 to the top, which is represented here. And we can see that little line right there coming down and touching that. And so I'll put it in a different mode so you can see it even better. So that's a 50% retracement, created a nice jump upward there. Actually, if you look at today's bar, big green bar, pretty fantastic actually. So up over 2% as we speak right now during the show. I have put a little channel in there so you can kind of see we're in that kind of 3,800 range on the S&P 500. And until you break out of that channel, a lot of this is kind of noise as far as that goes. But really good day today, and we'll talk about why that is as far as that goes. But overall, we're in a down market, as you can see by that kind of red trend line. And what we're really hoping for is some breakthrough here to kind of get us out of this and get us back into a primary trend, that's going upward. All right, so let's take a look at kind of what's going on here. So first of all, I presented this at the last show a couple weeks ago. I just want to present it again because it's really kind of important to understand. This is the SPDR S&P 500 ETF. The ticker symbol's SPY. This is going back to 2010, really kind of near the bottom for the last big downturn. And so the blue line that you see there that's running through there is called a regression line. And it looks at each point and it tries to find a line that finds the middle of those points. And so the key thing to that is, you can't see this very well, but it's a 14-degree slope. So that's the slope we were on prior to the pandemic. And then you see this big drop, right? And that obviously was the pandemic drop, and we shut everything down. The government came out and shoveled a bunch of money in front of everybody to try to stimulate things and keep the economies from going into depression. That worked, but it created a massive run-up. And so there's an orange line that runs through that run-up from the bottom of 2020 to the top that just happened last year. Now that's at a 54-degree angle.
Yeah, way too steep for a normal market.
Yeah, that's not sustainable. And so the thing is that the reason I'm showing this is because I've been having a lot of conversations with clients about how much money they've lost because they're locked into that top point, which makes sense. I get it. But it's another way to look at this is like, look, without the pandemic, we're probably still somewhere around that original blue line, and that's where we're heading to, it seems. And I think the biggest irony is that without the pandemic, we end up with a situation where we've got, even less money than we have now, if we look at that blue line, and a situation where we don't have a, big bubble. And we're probably still happier.
Yeah.
Because we didn't have this big run up. We don't look at that as money lost, and but it's difficult to capture. So altogether, we're just pushing the air out of this bubble. I mean, that's the main thing. And when I'm looking at charts and I look at, like a company like Apple coming down, through all kinds of technical indicators, we're just pushing the air out of the bubble where things got kind of overpriced, right? And now they're starting to come back down. And so a couple of key things I want to cover that happened this week that I thought were important. First of all was James Bullard, right? He's the Federal Reserve President for the St. Louis region. He is the most aggressive so far in interviews about talking about raising rates. When everybody was talking about a quarter point or a half point, he was talking about doing 1 point, 1% raise. They never did that. But this week, he talked about the fact that because money supply is starting to come down, and this is money supply going back, since 2020, And you can see it's slowly starting to deteriorate there. This is the total amount of money that's essentially sloshing around in our economy. And he says because money supply is starting to retreat, that should be potentially enough of a deterrent for growth that they're probably not going to have to do a lot more rate increases. So this is the guy who was on the other side, right? And so the market responded, I think, fairly positively to that. I had another client that asked me a question about the Federal Reserve balance sheet.
Yeah.
And so if you look in that shaded area here at the beginning of that chart, there's a big jump in money supply. And that's the money that was pushed out to keep us from depression. And if you look at the Federal Reserve balance sheet, you can see where that money came from. They started to purchase treasuries, mortgage bonds, and what have you. And you notice that they're selling that off now, right? So that started to decrease at the same time that money supply has decreased. So it's the Federal Reserve pulling money out of the market by allowing some of these bonds to mature, right? And some of them they're selling off. Originally it was 47 plus billion that they were doing, and then by September they got up to 95 billion between treasuries and mortgage bonds, right, that they're selling off. It's been a little bit opaque as to what they're actually doing, whether they're on that schedule exactly. Has been asked questions about it for the Federal Reserve Chairman Powell a few times, but he's basically, hey, we're just responding to the market. It's a guideline. This 95 billion kind of depends on what they have coming due. They look at what's happening in, say, the mortgage market and how much they're affecting the mortgage market. Those kind of things. So, but it is coming down. One thing that's important to understand about that money supply chart that we just showed. I'll go back to that because this is really interesting. If we get to April and money supply is still down, it'll be the first 1 year decrease in money supply going back to 1950.
Yeah, it's kind of a crazy set.
It is. It's now part of that's because we had this huge jump in money supply, right? So it makes some sense to have some decrease because we had sort of an artificial increase because of the Federal Reserve, because of the pandemic. So, we're still in this world of dealing with the pandemic, even though we might be going out to eat and doing different things. The world, at least economically, is still dealing with this, and so it's still something to consider as far as that goes. So I think that was an important component here. It's just, what is going on with money supply. Federal Reserve Chairman, who's very aggressive on raising rates, is talking about, hey, we might be, able to do a lot slower rate increases. These are really good things for the market. Well, today the market just took off, and we're having a huge jump that has to do with the jobs report that came out today. And this particular jobs report has something for everybody. I mean, if you are worried about inflation, well, it's got something for you. If you're worried about recession, there's something in here for you also. So if you're worried about recession, well, 223 jobs were created, 223,000 jobs were created in December. The expectation was 200,000. So, strong labor market. If you're worried about inflation, well, look at the labor market is slowly but surely actually decreasing in total number of jobs. And so that takes some pressure off of price in theory. And so that's a good thing. We also saw unemployment drop from 3.7, and it was expected to be at 3.7 again, dropped to 3.5. So you've got a scenario where unemployment is coming down and wage growth is starting to slow down. And so if you're worried about inflation, this is a really big deal to you.
Yep.
Right? If you're worried about recession, this is also a big deal to you because it means the Federal Reserve can potentially raise rates less going forward. And we actually saw the projection for total terminal rate drop today quite a bit based on this information. So still got a lot of jobs created, but the wage growth is slowing down. And we have some decrease in total number of jobs, which is good. So it's kind of the perfect mixture of a report, and that's why the market's up a couple percent today too.
Yeah, the market's looking for that kind of Goldilocks scenario where it's, everything's just right. It's not too cold, it's not too hot, and we're kind of going for that softer landing.
Yeah, and of course, most people don't believe it's even possible. And I hope we can get back someday and look at this and say, wow, they did it, or we did it, or so, there was enough good things going on in the economy, enough jobs being created, enough spending from consumers to offset all the other pieces. Well, supply started to catch up, and that brought inflation down by itself. And yes, we got interest rates back up higher, but things start to settle in, and man, you could really have a big market move. I mean, like today, like we're seeing. Once they got inflation under control in the late 70s and early 80s, 1982 was kind of the first full year where it was under control. It was a fantastic year, over 100% gain in 1982. So, that's the silver lining to this, is we can maybe get to a spot where this is all done. Yeah, we might have a recession. Seems like all the indicators are showing we will, but it doesn't mean how steep of a recession that will be, right? And that's really important as far as that goes. So just to get back real quickly to what's happening with the market and what we're looking for going forward. So we're in this range, kind of 3,800 range. Like to see it break out of that. We're getting right up to the top of that right now. We do have to be a little bit careful of putting too much emphasis on what's happening today. For example, at the end of last year, I did video after video talking about the fact that these large pension funds and large, target date funds were rebalancing. And the market came down. If you look at the end of the third quarter, same thing happened. So you had to be really careful to say, oh, the market's falling apart. It was a temporary situation that was happening. And right now, one of the things that's driving this is going to be short covering, because a lot of people, well, the majority of people and big money managers feel like the market's going to go lower. And unfortunately, when that happens, you get a lot of people that are shorting the market. And once the market starts going the other way and we get a surprise report like this that came out better than expected, so we get short covering. So it's not legitimate buying per se. It's people trying to save themselves from losing money. But you can start a lot of good rallies that way. So hopefully, we break through this 3,900 range. And then more importantly, we get through that red line.
Yeah, if we break that red line, then you can see the market really fly.
Yeah, and it probably would be some reason that that's happening, and some, I would suspect, because we're heading into the core portion of earnings season now, that if there was a catalyst, is that earnings are better than expected. And right now the expectation is that earnings could be soft because of the, poor market conditions caused by the higher inflation, and higher cost as people pay more for labor and those types of things. And then that the CEOs might be saying things negative about what's happening in the future. Forward guidance is probably a really big deal here. So if those turn out to be better than expected, we could see, that might be the catalyst that gets us through this. Again, because that would be unexpected. The short interest would still be there to a large degree. People would be covering shorts right through that line. And all of a sudden you got a bunch of other people jumping in thinking, okay, the market's taking off. So that would be great. On the opposite side, falling below that 3,800 range would be, important. Getting back down to that 50% retracement at around 3,500 would be another, bad sign. And so, these are the things we're watching for right now. But anyway, that's what's going on altogether with the markets as far as, I'm concerned for this week. It's an exciting day, actually. I'm really happy with what's happening so far. A lot of the data is coming out pretty decent. It's more of an expectation for what might happen in a recession and how bad that can be to earnings. That's really kind of going to make or break this situation as far as that goes. But things are improving in the inflationary front, which really does help.